is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I am Alex Tapscott. Andrew Young is off today. We have spoken a lot on this show about the potential of tokenization of assets. Now, this is not necessarily a new topic. People were speaking about the promise of blockchains to change how we move and store assets as early as 2014-15, but it's an idea whose time has come, in our opinion. And there are a lot of different reasons for that. One, the technology is ready for prime time. Two, the regulations and the policy environment has changed to make it more favorable. And three, there's real appetite from businesses and from investors for these kinds of solutions. That has been proven out with the tremendous growth of the stablecoin market, growing from a couple of $1 billion to nearly $300 billion this year. And many expect that number will exceed $3 trillion before the decade is through. But there's an even bigger pool of assets out there, securities, fixed income assets, real estate, you name it, that could benefit from being traded on chain. And that could mean more access for people around the world. It could mean different ways to customize those assets and ways to, offer more kinds of solutions and strategies to a broad global audience. We've had a couple of people on the show to talk about this, Carlos Domingo from Tokenized and Michael Sonnensheim, his deputy, as well as a bunch of other folks who are building some of these underlying technology platforms. And today we've got a very special guest, and I think the perfect guest to help us talk through it at this moment in time, which is September 2025. We've just seen the Genius Act passed. We may see more legislation. And really, I think we're experiencing this vibe shift where crypto is going mainstream and investors are trying to understand it a lot better. So with that, I'm delighted to welcome to the show Jim Hiltner, who's the co-founder and head of business development at Superstate. So Superstate connects financial assets with crypto capital markets through on-chain public listings and tokenized securities. Superstate was founded in 2023 by Robert Leshner, who's best known as the creator of Compound, something we've talked about a lot on the show, especially during the FTX debacle and the unwind, how a lot of centralized lending platforms went bust, but Compound managed to get through that crisis unfazed, in large part because it was on chain. So kind of a great DeFi legacy here with this business. In February 2024, Superstate rolled out the Short Duration U.S. Government Securities Fund, USTB, a fund backed by short-term U.S. Treasuries, today managing around $400 million, and have made a whole bunch of other big announcements as well. I won't say what those things are because I want Jim to talk about it. This is a very timely episode. They just had a huge announcement today, so we're going to jump right into that. But just quickly on Jim. Jim was director of sales at Compound Treasury, which, as I said, was the first DeFi company to get a credit rating from the S&P. And before entering the blockchain space, he was a VP at Pagaya, an AI-driven consumer credit asset manager. But an interesting mix, and a CFA charter holder like myself. So there you go. So a mix of TradFi and crypto. Great person to have on the show to help make sense of everything that's going on. Jim, welcome to DeFi Decoded.
Thanks, Alex. Appreciate it. That's a great overview, and I appreciate you not leaking all the alpha. You got to let me, have some fun with this as well too.
You get to spill the tea, Jim. That's what kids are. That's what the kids are saying.
Oh,
so,
okay. Yeah, I'm clearly. I got to get caught up on all the latest lingo.
Yeah. So, Jim, tell us a little bit about Superstate and the sort of the legacy from Compound to this firm. This is clearly a business that I think finds itself at an interesting and timely moment where people are really starting to think about tokenizing real world assets. This is not a new concept, as I mentioned. The concept of a security token, I think, came into the vernacular in 2016 probably, but now it seems like the rubber's really hitting the road. So tell us what to make of it all.
Yeah, it's the way that you articulated the Superstate origin story, kind of going back through 2021, 2022, I think is definitely the genesis of Superstate. But before all of that, I think Robert definitely had a twinkle in his eye as he was building Compound to not just allow smart contracts to move a bunch of crypto assets around, but to do the same thing for traditional securities as well. And so I joined him back in 2021, right as Compound Treasury was starting to build. And, that was an institutional product. It allowed investors that weren't really comfortable with setting up a wallet or lending assets into a DeFi protocol to get exposure to the amazing yield that were available in those markets. And it's kind of funny now looking back, because that was a short 4 years ago. The questions we were getting asked from clients was, what is a smart contract, but also what is a stable coin? And now that stable coins are, really becoming, the underlying infrastructure for moving money around the planet.
Yeah.
That's no longer really a question, but people are, at that time were really trying to understand, given the algorithmic versus fully reserved and so on and so forth. So anyways, that allowed us to kind of face off with institutions and tell them, hey, smart contracts are amazing at allowing people to borrow and lend in the compound example, and then I'll do a whole bunch of other things. And, we had about $600 million of assets that we were, just basically, as a debt security lending into the markets to earn, the market rate, but paying back a fixed interest rate. So it looked like a bank. And that's the way that we kind of described it, but it sat on top of DeFi rails. It kind of demonstrated that you can build, an institutional product, and underneath the hood, the operations were all driven on chain. And so from a headcount perspective, what takes a bank to do, $600 million worth of lending took us, instead of an entire department in Buffalo, took us 3 people in San Francisco to do this, because smart contracts are amazing. So, through the growth of that product and kind of demonstrating the institutional demand for that, we realized as centralized desks were unwinding, and smart contracts with 24/7 transparency and automated risk management were holding up extremely well versus the centralized ones that were opaque and done manually with a bunch of people in spreadsheets. Clearly, finance needs to go towards the former, not the latter. And so we looked around the table and said, what can we do instead of waiting for the world of finance to come to compound? Let's go build something that brings the world of finance to DeFi. And so Superstate, launched as an asset management business, really 2 funds that we run today, about $800 million in total assets under management. Our T-bill fund is as boring as you can get on one side of it. And it's just treasury bills, short duration in a bank account. But the power of the blockchain makes that product, stablecoin compatible. It makes it 24/7. And there's a whole bunch of things that make that really interesting. But, we decided to take the infrastructure from the legacy financial world and bring it into DeFi in a fully compliant, regulated way. So, we run an RIA where an SEC registered this, and there's a whole bunch of licenses and infrastructure that we built that looks very much traditional, but the technology that we built, allows for assets to be compatible with the systems that, have demonstrated resilience and scalability over the last decade or so, to the tune of, $100 billion of DeFi TVL and Ethereum, and growing, literally day by day, especially with the birth of stablecoins. So, there's a lot that we're doing on the asset management side. And then, we've also kind of taken our talents to the equity space. We see a lot of effort, being put towards, uprooting, multi-trillion-dollar asset class, because the legacy infrastructure just doesn't make any sense. And so, as we kind of built a lot of capabilities on the asset management space, we have extended that into what we call Opening Bell, which is our equity issuance platform. So, lots for us to dive into there. But, the origin story really came from deep DeFi roots and even, TradFi roots for both Robert, myself, and the entire team before, doing everything full time in crypto.
Yeah. Well, you made so many different great points there that I want to unpack. The DeFi legacy one, I think, is particularly interesting. And I think a lot of people conflate DeFi with, or think of DeFi as a sort of a subset of crypto, which is a subset of fintech, right? And my point of view has always been very different, that fintech fundamentally is just sort of a lipstick on a pig in a way. Basically what it is a better, sleeker user interface, which allows you to access a range of financial services. But in the end, you're still interfacing with banks, brokerages, custodians, clearinghouses, transfer agents, all the same legacy players, and the underlying tech stack could be decades old. Whereas what DeFi was trying to do was something much more ambitious, which was to reimagine the functions of the financial services industry from the ground up. So what does the industry do? It gives you a way to move money, to store money, to access credit, to get access to funding for a new company, to organize financial information, to trade, and so forth. And so things like lending protocols, stable coins, decentralized exchanges, we're all reimagining the nature of the industry, or what it does from the ground up. And Compound is one, speaking of just the legacy, that I think was an exemplar of that. And I think today still has, over $1 billion of loans collateralized against like $3 billion of crypto assets. And I think that, if you're going to build a company in the space that's trying to bridge that gap from crypto to TradFi, having that grounding in DeFi, I think, is incredibly important. So that's just an observation. In terms of the business itself today, you mentioned stablecoins. Stablecoins, I think, were sort of the first killer app, right, for crypto in a way. They kind of found perfect product market fit. It turns out there are a lot of people in the world that want a way to move and store dollars digitally without the need for a bank account. Or even if they do have a bank account, to have an on-chain way to do that for all sorts of other reasons. And I think that, the promise to me of tokenized RWAs and securities is that once someone has a US dollar bank account, the next thing they want is a US dollar investment account. They want to be able to take those dollars and deploy them into capital assets that can grow and compound with time. Because most people in the world don't have access to dollars, let alone until stablecoins came along, let alone a way to buy Mag 7 stocks or own a piece of US real estate, or invest in IP or royalties, or these kinds of assets that people build wealth here in North America. I'm in Toronto, but it's basically the same thing, right? So to me, that was always the promise, is let's globalize assets, let's democratize assets the way that the internet did that with information. Now today, though, your business, these funds, they're still mostly focused on U.S. investor class, right? Are you able to offer? Please correct me if I'm wrong. So the funds that you guys have, the products that you're launching, who can buy them, I guess, is the question.
Yeah, it's a great question. And so, before I answer that, I think you're 100% right. I mean, the genesis to launching this was looking at, hundreds of billions of dollars in stablecoins that are sitting around earning nothing. And the only opportunity for investors to deploy that and earn some interest was into DeFi protocols. And not everybody is comfortable doing that. And so you had a lot of call it deadweight capital in an inflationary environment when the Fed is raising interest rates. And, the yield on chain was actually going the opposite direction. All of a sudden treasury bills were earning more than, supplying USDC on Aave or Compound. And even that to begin with wasn't something that everybody was comfortable with. So from a demand perspective, yeah, there was just idle capital sitting around on, investment fund balance sheets, on corporate treasury balance sheets, on, payments companies balance sheets that just wasn't earning anything. And so that was, part of the reason why launching USTB on the money market type of product was to help people activate that in a risk-free investment, but make it in a way that's, not where you have to burn your stable coins and then wire money over to a bank account and invest 4 days later. It's no, click a button and transfer USDC to an address, and then boom, 5 seconds later, or whatever the next block come from, you're now earning interest at 4% annualized or whatever the Fed funds rate is. So 100% from a macro standpoint, you're absolutely right. These are institutional funds today because, historically up until, the election last year, the SEC wasn't really comfortable with approving for broad retail access, tokenized funds. If you look at everything, take away the fact that you can hold the shares in the fund as a token, it's just a 2a7 money market fund, which is a very technical term, but, it holds short duration T-bills in it. We're pursuing actively with the SEC to register that and convert it to a publicly registered fund. That being said, today, even though it's institutional only, we service customers all over the globe. The U.S., it's a Delaware statutory trust, so we can definitely serve investors here in the U.S. We have a private placement memorandum, PPM of the fund, so people can see exactly the disclosures and the risks. But we also have, investors in BVI and Cayman and Singapore and the UK and Ireland and you name it, all over the globe. Such that they must be accredited investors, but we're able to distribute the fund globally. So it's not just restricted to the U.S. And it's the same thing for our carry fund. Our carry fund is same exact structure, same distribution, just a different investment strategy under the hood. That one is averaging 10 to 15% yield just because it's doing the basis trade and tokenizing a very popular strategy in crypto, which is buying spot crypto and shorting futures against it. And the delta between the two of those pays you a pretty handsome yield, market neutral. So you don't have like crypto volatility, but you take advantage of the fact that there's a spread between buying spot Bitcoin at 100K and shorting Bitcoin futures at 110K in equal size means that you get a 10% yield annualized on that. So anyways, there's a lot of applications for that. We just announced as of last week, USCC and USTB, so both of our tokenized funds, are great to hold on chain, but they're even better when you can use them in DeFi. So Aave, who's like the largest DeFi protocol in crypto, probably the biggest success story in all of DeFi, has created this new Horizon RWA market. And so RWA, real world assets, you can use USTB and USCC as collateral in those markets. So like 15% yield on USCC and borrow stablecoins at like 4 or 5%. And you now have a positive carry on that borrow to go off and do other things or to loop it back into the fund. So we spent a lot of effort on our side, and just to like make it very clear to the audience, this is not just you launch a token and all of a sudden, boom, it's live in Aave. Especially when you deal with securities, there's a lot that we are responsible for in terms of making sure that our assets are KYC'd in a compliance perimeter of wallets and smart contracts that can actually interact with these securities. Because anytime the SEC wants to look in and see, have you done your KYC? Are the assets held by somebody that's not on the sanctions list? Like, we can answer all those questions, and we make sure from a technology standpoint, given how we know how DeFi operates, we actually make all of our assets compatible in certain DeFi protocols that respect the compliance rules that the underlying securities laws have. And so there's no difference in terms of, that infrastructure. It's just, done on chain versus done in like a traditional, bunch of people in a middle office. It's done.
Well, that's always been my thinking, which is that, a security is in and of itself fundamentally a contract, right? Like, if you own a share of a company, you have a legal right to a piece of a common enterprise. And, if there are any dividends, you get a piece. And if there's a vote, you get a say. And like, those are all terms that are sort of written into the share certificate that you hold, right? And so why not have all that written into a smart contract versus a regular contract, and put it all on chain? So I think that insight is a really good one. I think, like, thinking about what you said a little bit more deeply, I want to talk about the Opening Bell platform a little bit more, because there's some debate as to whether or not Apple stock or Exxon stock or JP Morgan stock is ever going to be natively on chain, right? But there are tons of assets that already are natively on chain that began in the world of crypto. And then there are companies that operate in the crypto industry that maybe have public listings, but are exploring doing tokenization because they themselves, I think, want to be a model user of the technology that they're advocating for. And also, they probably see it as a big economic opportunity. So I know you guys had some news on that. So do you want to talk a little bit about that, Jim?
Yeah, I'm super excited. Today we announced, GLXY Digital. So they're a $10 billion publicly traded on the NASDAQ crypto native company. They're also doing a lot in the AI data center world as well too. But we've spent a lot of time over the last few months with the GLXY team, and really thinking about tokenization, and the way that Superstate has built its business directly aligns with what they're looking to achieve, which is to be the first to bring their shares, canonical shares, directly on chain. And so we did that this morning, announced GLXY is the ticker. They actually tweeted out the contract address, which is really cool.
I saw that.
Yeah. So that is the actual direct GLXY Digital Class A common stock on chain. And so, there's been a lot of discussion about tokenizing equities. And, what we found is that a lot of the approaches kind of do wrapper or synthetic approaches where, they'll take the existing shares that trade in, the NASDAQ or the NYSE and put them in like a wrapper of a vehicle, then issue interest in that vehicle for token holders to hold on chain. The problem with that, in our view, is that it just adds more layers to the layer cake. If you think about how TradFi operates today in the equities world, very simply, like, there's shares in a vault at DTC, and then there's a bunch of broker dealers at the next level above that hold the stock basically in street name under like Schwab and Fidelity and the likes. And then above that is all the retail users that want to trade, and there's clearinghouses and whatnot in between. So there's like a big stack in TradFi that just has a ton of complexity, and the genesis of that was really because of the paperwork crisis. Like it's just bringing centralization around a problem that technology couldn't solve at that time, but now technology can solve it. Like people can hold things in their own custody and interact with each other on the internet, and the technology of a distributed database can actually update that in real time versus needing like 1,000 people to go and like check a box to say whether or not somebody moved shares or bought or sold at this time. And there's a lot that can be done to make traditional equity market structure better. So that's what Opening Bell is trying to achieve. So Opening Bell, just very simply from an investor standpoint, is they KYC their wallet and they go and they hold GLXY common stock, not in their Robinhood or their Schwab account, but in their MetaMask or Phantom or whatever wallet that they have KYC'd. So they're holding it directly on chain. And what's cool from the investor standpoint is, so from the investor standpoint, like they get to trade 24/7 and be able to use it as collateral in DeFi. And there's a whole bunch of like really cool use cases around that we can dive into. But from an issuer standpoint, from GLXY's perspective, they know that their actual shares are, they partner with us. We're an SEC registered transfer agent to issue those shares. And we give them visibility 24/7, 365 into like all the holders of their stock at any given time. They don't have that visibility in TradFi. So, kind of like fusing these two worlds together, to your point, there is, a very standard regulatory apparatus underneath the hood in terms of our transfer agency and disclosures, like SEC disclosures with, GLXY's latest earnings. They mentioned Superstate as their digital transfer agent in their 10Q. So investors know how all this works. There is no questions, ifs, ands, or buts about it. But now they get to like have direct ownership of the shares and the same exact like voting rights and dividends and all that kind of stuff, because Opening Bell shares are the actual shares and not like a wrapper of something else that is held in an SPV offshore. So super excited about that. That's the first of many. We've definitely announced folks like Soul Strategies and Upexi and Exodus, and there's dozens of others that are looking at this as like publicly traded companies helping bring their shares to the chain, as well as like private companies that are thinking there's got to be a better way for me to IPO, and maybe like crypto capital markets is the future versus doing the traditional roadshow and S1.
Well, that's kind of the blue sky for all of this, which is obviously putting GLXY on chain is innovative, and having it be collateral that can be used to get, basically an on-chain margin account against your portfolio is very innovative. And it's an interesting kind of fusion of the compound and the tokenization models. But like the real upside is we have an existing system today for companies to raise capital and then to get issued, to go public and then trade as public companies. And it's this well-worn process, and it works okay. And it hasn't really evolved all that much in 85 years, right? Basically since the Securities Act of 1933. And now we have this new technology toolkit that allows us to reimagine how companies access capital, how the assets trade, how those assets are used in the financial system, using blockchain networks, essentially. And so it's so to me, it's like, Apple, Exxon, JP Morgan, I use these as just sort of like old school companies. If they, at least for them right now, it may take a while for them to tokenize because they're sort of entrenched in the way things work today. And, with these ones that you're working with now, they're sort of in between. They're on the margin. But ultimately, the real upside is when a whole bunch of companies, not token projects that have unclear, business models, but actual companies, fundamentals, choose to get access to capital and get liquid using a security token offering, in effect, rather than going about it either the VC or the IPO route. And what's so interesting to me about this is like we've had a lot of kicks at the can, Jim, at trying to do this in crypto. Like the ICO boom was flawed, deeply flawed for a lot of reasons. But one of the reasons was not the technology itself. Like what ICOs proved is that you can launch something and you can raise capital from a global investor base who can put in amounts big and small and can become stakeholders in this thing. Now, that's a very rosy view of things. Like in the end, what was the thing they were investing in? What kind of rights did they have? What kind of recourse did they have? What kind of disclosures were the founders making? What kind of third-party audit was occurring, right? So there are reasons why securities laws and regulations exist to protect investors and to create orderly markets that people can basically trust, right? And even in traditional markets, they don't always get it right. But to me, it's like the technology toolkit is there. Now, if you have that's how I started my introduction. There's like the tech, there's the rules and regulations, then there's the appetite from the market. And it seems to me like the tech is really ready for prime time. And I want to talk about your choice of using Solana in a second. There's a market, we know there's a product market fit, especially from stablecoins. So now we've got this rules and regulations thing. Like if we can figure out a way to allow companies at a lower cost, because to me, it'd be like if you can lower the cost and improve the distribution and automate the back office, then more and more companies are going to choose to do this rather than the alternative. Because it's not a 1.1x improvement. It could be like a 10x improvement if you take those benefits across the board, right? So anyway, so that's my long-winded, but basically like, I guess that's a way of saying, with Opening Bell, like what is the vision that you see for this thing in a few years, assuming that some of these pieces fall into place? Like how big could it be? What is its impact on the world of business, not just on crypto?
Yeah, no, I mean, all fantastic points. I think I agree with you. You need early adopters to prove out the business model. And those early adopters are certainly the most crypto native, forward-looking public companies in the world. I mentioned a handful of them. There's more to come. They're definitely seeing the explosion in on-chain capital markets, both from the distribution side, but also from the demand side. On the demand side, what's interesting, I did some research and was kind of like looking into it. Pump Fund and Plasma, right? They raised Pump Fund was what, $600 million in 12 minutes.
Yeah.
Plasma kept lifting its cap on a daily basis till they got to like $300 or $400 million that they got to raise. Like there's real capital out there. And what was interesting is that, a big part of the pushback that we hear all the time from people that are like more like crypto native is like, nobody's going to want to KYC and actually, buy these things because crypto is all about degens and anons and all that kind of stuff. But it's not true because like a lot of those raises were done with KYC. And by the way, they were all ex-US. US capital markets is dramatically bigger than everywhere else. And it's because of all the protections that you outlined. And it's because of just like how robust, legacy, historically, the capital markets have grown here. And so doing it under SEC publicly registered, formats, whether it's an S1 or other types of like filings to disclose how the business, the fundamentals, the audits and all that kind of stuff work, we think is a really viable path for companies to raise like serious capital. And, I think what will be interesting is when more and more, my like main thesis is like, bringing GLXY and Soul Strategies and things on chain is really cool as like a first step. The next thing that's really cool is when those companies decide to do things like issue unique dividends for like token holders or like people that like hold their stock for a certain amount of time. I had one of my clients ask me, when people move their shares or like they, do I have visibility into when they first bought that share? I'm like, not. TradFi does not track that for you. But like we would, because on chain, we could see like this address bought the stock on, September 3rd and sold it on September 10th, or if they held it for 6 months, like there's interesting economic incentives that companies can do by having the visibility into their loyal shareholder base. Like that to me is going to be really interesting.
One of the things you might have to figure out though is how to re-anonymize that at some point, because in the public markets, there's some benefit to shareholders being able to acquire shares in a company anonymously. I mean, eventually they meet filing reporting requirements where they have to, say that they own a certain percentage, but you can imagine a creeping takeover by a company or an activist investor wanting to get involved. And I think, broadly speaking, it's good that they can do that at least a little bit at the outset without triggering any kind of red flag. So I almost wonder if there's like a ZK wrapper or something that you can say, like, you can prove that someone bought the shares without saying and like you can prove that it was KYC'd without maybe saying this is an address that belongs to Pershing Square, who's acquiring this company.
Right.
They want to put someone on the board or something like that.
Yeah, I don't know. No, I think people will get creative. I think people will get creative there for sure.
Yeah.
But kind of like going back to then, what's interesting is on the private side, because the way that a lot of IPOs work today is very centralized. It goes through like a handful of banks. It's really expensive and takes forever. Like those are all reasons why technology and crypto capital markets are better. And so I think the explosion of deals that are going to come on, through the same type of like underlying business fundamentals and registration requirements, but distribution wise is going to be totally different. That's what is really exciting about opening Bell. Is just, taking the amazing technology that exists in digital asset, crypto markets, fusing that with existing publicly registered securities, but then also using the launch pads of the world, to like bring investors access to great fundamental businesses versus trading a bunch of meme coins and, getting their face ripped off when
Right.
launches something and it's BS. So the time has come for that all to turn, and a lot of it's being driven by like legitimate businesses like Superstate that have been building for 2.5+ years, that know DeFi, that know regulation, and know how to fuse those worlds together. So this is just the start of a tremendous amount. Now, if I fast forward into like a couple of years from now, I think you're not even going to know that Superstate's really involved in this kind of stuff. You're going to have businesses that, go an IPO. Nobody knows who the transfer agent is on, the Circle IPO, unless you like really dig into the S1. Nobody cares, but people just buy the Circle stock through the brokerage account. I think something very similar is going to happen. And we'll abstract ourselves into, embedding into distribution channels like major wallets or exchanges or brokerage platforms that, to be honest with you, like Stripe buying Bridge was so that they didn't have to put Bridge as like the front end of Stripe. They're just making their business 80% better margins by using stablecoins in the background. Like the same thing's going to happen for TradFi when they put everything on chain and decide that, their operations are going to be more improved through infrastructure delivered through companies like Superstate.
Yeah, absolutely. So in the little bit of time that we have remaining here, can you talk about the technology that you're choosing to build on? I believe the language I saw was that starting with Solana, which suggests that you guys want to be multi-chain, which I think, like DeFi protocols, that is how they scaled as well. But like I think of Compound and Robert, your co-founder, is kind of being like Ethereum guy. So, at least originally, I mean, can you tell us a little bit about the choice of the technology platform that you're starting off with?
Yeah. It's very simple. When we started our asset management business, we launched on Ethereum first, and then we expanded to Solana second. And that was, very intentional given what you described. DeFi TVL is $100 billion there. And Solana was relatively nascent at the time. Solana is definitely, trending up and to the right at an accelerated pace. And, from the issuer standpoint, some issuers choose to launch on Solana versus Ethereum. GLXY, in their case, wanted to launch on Solana first. But certainly Superstate has the infrastructure to support both networks and really any network, SVM or EVM compatible in short order, and you'll see us expand to multiple chains. Just wherever the vibrant ecosystem is from a demand and utility standpoint, we're really kind of agnostic and want to be Switzerland and make sure that issuers, investors, and the protocols are all happy that they get to interact in this vibrant market. And we're not choosing winners or anything necessarily. We just want to be where the demand and the flows are.
Yeah, no, that makes sense. Listen, this has been a really interesting conversation, Jim. Congrats on the big launch today. Really exciting. I think you might be responsible for a little bump in the overall crypto market. I think that this, along with some other news, is helping to put some wind in the sails. But bigger picture, really excited about what you're doing. We're really interested in the convergence of the crypto market with traditional markets, how the lines are being blurred, and how this technology is enhancing and improving how the industry functions. in how investors access capital. So really great to speak with someone building that out, executing in a kind of sane and responsible way as well. And that was one of the other big things I gleaned from this conversation. So it makes me feel pretty bullish on the whole space and on what you guys are doing, that we've got responsible actors like you that are taking the approach that you have. And looking forward to what happens next for Superstate. So thanks so much for joining us. That's it for this week's episode of DeFi Decoded. I'm Alex Tapscott. Please remember to like, share, comment on the episode wherever you listen to it or watch it. It helps other people find the show. Until next time, take care. Bye-bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.